Hi, welcome to the topic Cash Cycle and its Journal Entries. Today we are going to learn about cash cycle and what are the journal entries that are posted in cash cycle. So let's understand what is cash cycle. So let's understand what is cash cycle. Cash cycle can be said to be a time period between the payment that you make for the purchase of raw materials or labor and the payment that you receive from the customers after the sales. So time period between these two activities would be known as cash cycle or cash conversion cycle. So let's read the definition. It is a time period between payments made for materials and labors and payments received from sales. So looking at this diagram, we can have an idea of exactly what is cash cycle. So we take inventories or raw materials from creditors and then we make payment to the creditors after a certain period. We are not going to make the payment immediately because we know that our customers are not going to pay us immediately as soon as we give them the goods. They are going to take some credit period. So we also take some credit free period from our vendors. So we make payment to the creditors once they have given us the inventory, and then this inventory is converted to finished good and sold to the customers on credit. Hence we have debtors, and then the collection team converts this debtors, that's accounts receivable, into cash. So this entire cycle will be known as cash cycle. Let's understand it better from this diagram's perspective. So the entire activity that we can capture that's happening in an organization is the procurement of raw materials, payment to the creditors, because as I told you, we are not going to immediately make the payment along with the procurement. We will be taking some credit period. So after the credit period, we are going to make payment to the procurement from whom we have done the procurement. That means we will be making payment to our vendors, and then we will send this raw materials into factory for processing to convert it into a finished goods, and then this finished good after processing via warehouse is going to be sold to our customers. Hence the next stage is sales. And sales is not happening in cash because the customers would be looking for some credit period. So once sales is done, we need to collect money from the customers to whom we have sold goods on credit. So last stage will be collection. So if we see this is the entire time frame that is represented through this particular line, and the stages are procurement, payment, processing, sales and collection. Now, but for the time we have procured the goods until the time we are making payment, this entire duration will be captured as accounts payable, because as per the definition of accounts payable, it is the amount to be paid to the customers, it is the amount to be paid to the vendors for goods and services purchased on credit. So accounts payable appears in the books when we have purchased from our vendors on credit and ends in our books when we have made payment to them. Accounts payable is a liability for a business. Now inventory will be with us till the time we are it will start from the time we are procuring the goods. It will be there with us at the time of payment. It will be there at the time of processing, and it will be there till we are selling the finished goods to the customers. Because by inventory, we would include three portions of inventory. That is inventory for raw materials, inventory for work in progress, and inventory for finished goods. So till here we'll have raw material in procurement and payment stage. In processing we'll have a work in progress inventory, and till sales we'll have the inventory for finished goods. So these four stages are actually covered in inventory. Now third would be accounts receivable. It will start when we are making sales on credit to our customers and will end when we are collecting money from our customers. Because the definition of accounts receivable says it is the money to be collected from the customers for the goods and services sold on credit. So starting point for accounts receivable would be sales and ending point would be collection, because collection is a process is to convert accounts receivable into cash. So once accounts receivable gets converted into cash, it's no more our asset, it won't be there in our books. Hence this entire stage can be broken into three subcategories. One is accounts payable, second is inventory, and third is accounts receivable. Now if we pay a little bit attention here, we'll see that during the procurement stage, when we have purchased goods from our vendors on credit, till the time we are making payment to these vendors, cash doesn't play any role. The role of cash starts only when we are making payment to our vendors, and it ends when we are collecting money from our customers. As the definition says, once again, it is a time period between payments made for the materials and labors and payments received from sales. So payment received from sales would be collection. Now to calculate this particular stage, right? So this entire stage will be known as a cash conversion cycle or cash cycle. So to calculate this entire stage, what we can do, we can add inventory, which covers from procurement till sales. We can add accounts receivable, which covers from sales to collection. That means we have covered everything from procurement to collection by adding these two. But since cash doesn't play any role between procurement and payment, because the role of cash starts only after payment, so if we remove this accounts payable after adding these two, if we remove this procurement to payment duration, that is accounts payable duration, what we will be getting is cash conversion cycle. I hope now it is clear exactly what's the cash conversion cycle. Is the duration between inventory, is the duration of inventory right from the procurement of inventory to the sales, plus accounts receivable right from sales to collection, minus accounts payable duration, that is from procurement to payment. Hence we can represent it through this particular formula, which says cash cycle is equal to DIO plus DSO minus DPO, where DIO would be days inventory outstanding, that is this duration, plus DSO, that is days sales outstanding or daily sales outstanding, that would be from sales till collection, minus DPO, which will be days payable outstanding, that would be your accounts payable duration. We'll look into the formula how to calculate DIO, DSO and DPO individually. So just to repeat the formula of cash cycle once again, it is days inventory outstanding plus days sales outstanding minus days payable outstanding. So now let's go ahead and see the formula to calculate DIO, that is days inventory outstanding. The formula will be inventory will be a numerical, cost of sales will be as denominator into number of days. Let's say if we are calculating our number of days is 1 year, we can take number of days as 365. In this case, whatever is the inventory that we see in our balance sheet, that includes all the three: raw materials, work in progress and finished goods. Whatever is the closing stock will be our inventory. Cost of sales, we can calculate cost of sales, because cost of sales is also known as cost of goods sold. The formula would be opening stock plus purchase minus closing stock. If we use this formula, what we'll be getting is cost of sales. I repeat the formula for cost of sales. Cost of sales is also known as cost of goods sold. Hence, our formula would be opening stock plus purchase minus closing stock. Hence, we will calculate cost of sales using that formula into 365 days. That's the number of days in a year. So let's say our inventory is coming to be 1 lakh and our cost of sales is 4 lakhs into number of days is 365. For easy calculation, we can take it as 364 as well. So this should be 1 by 4 of 364, that is close to 91. So 91 days would be the days inventory outstanding. That means it takes on an average 91 days to convert raw materials into finished goods and then selling that finished goods. It takes our entity 91 days on an average. So that would be your DIO, that is days inventory outstanding. Now let's go ahead and see what is DSO, days sales outstanding.